Yesterday, our analysis focused on, well, the complexities around Vision Wave Holdings. Today, though, we're pivoting to a really classic financial puzzle. GrabAGun Digital Holdings. This is a company that, on the surface, appears to offer some deep intrinsic value, while at the same time flashing these pretty catastrophic market distress signals.
Yeah, that's right. GrabAGun operates in that, pretty competitive online space for firearms, ammo, accessories. They just completed their NYSE listing via a business combination with Columbia II back in July 2025. Now, the stock recently closed at $5.13, which really puts us in a genuine dilemma here. Is GrabAGun actually priced for deep value? I mean, considering its strong internal support and that, virtually debt-free balance sheet? Or do the really severe price collapse and these, frankly, alarming liquidity ratios point to fundamental operational risk that maybe insiders are just trying to defend against?
And I'll be arguing that the combination of, balance sheet strength, analyst conviction, and management's pretty aggressive capital allocation signals a compelling recovery potential. It confirms, in my view, that this stock is profoundly undervalued right now at $5.13.
Okay. And I'm going to argue that while, yes, those value metrics are attractive, the severe market rejection, you see it in the catastrophic stock performance and the critically poor liquidity, it just overrides that insider conviction. It points instead toward major operational fragility that maybe the low price is correctly reflecting.
So my thesis really rests squarely on those intrinsic value metrics. You've got the stock trading at $5.13, while its stated book value per share sits at $8.13. Now that creates a price-to-book ratio, PB, of just 0.63. Essentially, the market capitalization, about $161.83 million, is significantly less than the, let's say, theoretical liquidation value suggested by its assets. This isn't just cheap. This is a pretty clear deep value indicator.
That PB ratio is indeed tempting. But I think we first need to establish the just overwhelming data showing what looks like a market failure here.
Hang on, let me just first solidify the internal support structure, because it's important. Beyond just the numbers, right, we have what I see as undeniable conviction from the leadership. Insider ownership is quite robust at 30.21%. And maybe more importantly, we saw concrete open market purchases back in August 2025. This was by the CEO, Mark Nemedy, and directors Kelly Reisdorf and Chris Cox, all executed between $5.11 and $5.34. These people are putting actual real money behind their belief. And then add to that the balance sheet stability, which is, exceptional. Debt to equity and long-term debt to equity are both 0. 0.00. Zero long-term debt provides a, frankly, massive cushion. So when you combine this with the external validation, Roth Capital initiating a buy rating, target price $8.25, all the evidence seems to suggest the market is just suffering from an extreme and probably temporary fear response.
While, okay, that $8.13 book value is certainly a data point, the market action itself suggests the company is, currently dysfunctional, maybe? You just can't separate sentiment from operational consequence when the stock is down staggering 62.28% for the quarter and 56.34% year to date. And it closed 76% below its 52-week high of $21.40. Look, that level of collapse isn't just a temporary overreaction. It feels like catastrophic market rejection, signaling a fundamental issue with how it was valued post-IPO.
But that catastrophic performance is precisely why management is acting, which I think brings us neatly to our first point. How do we interpret these insider actions? I view the company's capital allocation as aggressive support for shareholders. They authorized a pretty significant $20 million share repurchase back in August, right when the stock was already deeply discounted after the IPO. Now, that amount, you set it against a $161 million market cap. That's a material commitment of capital. It's meant to consume its own float and capture value, right?
It feels like you're elevating the symbolism of the buyback, maybe above the reality of the price action. Look,
insider buying and a buyback authorization when the stock is down 76% from its high, that often functions as a defensive measure, doesn't it? Aimed at managing perception, trying to establish some kind of floor, rather than being purely an investment signal. The market often sees this as just damage control, and the quantitative data seems to back up market apathy here. Institutional ownership is low, only 18.98%. I mean, where are the big funds if this is truly such a deep value opportunity?
But the insider transactions figure is positive, 0.42%, indicating net buying. The company is actively consuming its float. This commitment, backed by, real purchases from the CEO and directors, it proves that management's valuation model differs pretty dramatically from the current trading price. They're acting like long-term investors in their own company.
I'm just not fully convinced by that line of reasoning. Because, well, if the fundamentals truly supported this recovery narrative, wouldn't the short interest be feeling some pressure? Yet the short ratio is only 1.15. That's pretty low. Short sellers don't seem to be covering in a panic. They seem comfortable holding their positions against management's attempts to stabilize the price, which suggests they believe the operational risks just outweigh that PB value floor you mentioned. The buyback looks like a defensive line, sure, but it doesn't seem to be preventing the retreat.
Okay, well, this leads us directly into our second and probably most critical area of disagreement, financial stability. Or maybe the trade-off between that zero debt structure and the immediate liquidity situation.
Exactly. You made a compelling argument regarding conviction, but we just cannot move past the fundamental operational risk presented by those liquidity ratios. GrabAGun's quick ratio and its current ratio, they're both extremely low at 0.31. I mean, this isn't just a slight concern. This is a major red flag suggesting potentially immediate solvency issues.
I absolutely concede that the 0.31 ratio is undoubtedly a severe point of distress, especially for a retailer. You have to maintain high confidence with your suppliers.
Precisely. A current ratio of 0.31 basically means that if GrabAGun tried to pay all its current liabilities using only its cash and, near cash receivables, they'd still be short something like 69 cents on every dollar owed. Now, for an e-commerce retailer dealing with inventory cycles, managing supplier credit lines, this kind of operational choke point is highly dangerous. It risks disrupting their entire supply chain.
Okay, I see why you think that, but let me give you maybe a different perspective on the risk calculus here. While the ratio is alarming, yes, the zero long-term debt position, I think, fundamentally alters the company's ability to navigate this crisis. They have no fixed interest burden, right? No looming mandatory capital repayments. This zero debt structure gives management immense strategic flexibility that, competitors saddled with leverage simply don't have. They face zero creditor pressure from major lenders.
That flexibility sounds great, but it feels theoretical until they can actually pay their suppliers, next week. They still need cash, right?
But that is the crucial differentiator, isn't it? Every single dollar generated from current operations, however small it might be, can be dedicated entirely and immediately to shoring up that working capital position and paying down those current liabilities. And we know they are minimally profitable. They reported $3.08 million in income, which translates to a low, yes, but positive return on assets of 1.72% and return on equity of 1.80%. Now, these figures, combined with the zero debt structure, indicate to me at least a survivable operation, one that can potentially self-correct its balance sheet issues internally, unlike, say, a highly leveraged small cap where any profitability gets immediately eaten up by interest payments.
Okay, survival is one thing. Justifying a deep value investment is another. And this brings us to point 3, where the valuation ambiguity, I think, really undermines your whole thesis. This conflict between the stated income and the reported revenue.
So you're challenging the foundational metrics. But the PEB of 0.63 is based on, verifiable assets and liabilities. It provides, I still argue, a powerful intrinsic floor. And this is supported by that $8.25 target price from Roth Capital, which confirms that, external professionals do see significant upside potential based on this valuation discrepancy.
That's an interesting point, though I would probably frame it differently. How can we possibly trust the veracity, the realness of the book value when the financial context is just so opaque. The source material explicitly reports sales as $0, 0.00 million, yet somehow they reported $3.08 million in income. This is the central conceptual hole for me. How can a retailer possibly be profitable with zero sales?
Okay, I concede the zero sales figure is alarming, I agree. But given the structure of the recent SPAC listing, we really have to consider the non-cash components that are often inherent in post-combination accounting. That $3.08 million in income, it likely stems from maybe a massive non-recurring gain, or perhaps an accounting effect related to the business combination itself, maybe a contingent liability being reversed, or the valuation of certain non-cash assets post-merger. It feels like the operating revenue streams just haven't stabilized their reporting structure yet, which, let's be honest, is a pretty common pitfall in the first few quarters right after a SPAC listing.
Okay, but if we accept your premise that the income is essentially non-operational noise, then the price-to-earnings ratio of 35.45 becomes basically worthless, right? And the lack of reliable revenue metrics means we cannot calculate key operational checks like price to sales or EV to sales. So you're left relying almost entirely on book value alone, which is inherently unstable if the underlying business model generating the cash to maintain those assets is itself unreliable or, as you say, unreportable yet.
The lack of a clear PS doesn't negate the tangible nature of the book value, though. And while the market has, yes, hammered the price, look at the volatility figures. They're actually low. The beta is just 0.06. Now that suggests very low systemic risk exposure.
An extremely low beta like 0.06 doesn't necessarily imply safety. It often implies the stock trades completely independently of the broad market, which, given its massive drawdown, is more characteristic of specific, company-related, idiosyncratic catastrophe. It means the market is pricing in issues unique to GrabAGun, not broad macroeconomic resilience. The only thing stable here seems to be the rate of collapse.
Okay, so to summarize my perspective, the case for GrabAGun rests on what I see as verifiable deep value, the $8.13 book value per share, the 0.63 PB ratio, and undeniable insider conviction demonstrated by those aggressive open market purchases and the concrete $20 million share repurchase program. The key strategic advantage for me is the zero long-term debt structure that gives management the flexibility to repair the acknowledged working capital deficit over time. Basically, the stock is simply mispriced and poised for recovery toward that 825 analyst target once the post-SPH reporting stabilizes and the market moves past this initial, 62% quarterly panic.
And I maintain that the theoretical value floor provided by that low PB ratio is frankly far outweighed by the immediate demonstrated operational fragility. That 76% drop from the high clearly demonstrates market distrust. And the critical liquidity issues, specifically the 0.31 current ratio, point to a potential imminent crisis in just paying suppliers. Management's defense attempts, yes, they're notable, but they fail to address the fundamental ambiguity in core operational metrics, specifically that suspicious $0.00 million reported in sales, which makes any internal valuation metric highly suspect in my view. The evidence points more towards acute operational distress masking itself as value.